Because if the whole purpose of the policy was to incentivize
Risk taking. Yeah. No, it's a good question. I think this is more about aggregate risk taking in the economy than about corporate strategy. So as a corporate strategist, and by the way, for corporations it's different, right? For corporations corporations have got much more ability to optimize their tax structure than an individual. There's a lot more they can do. At the end of the day, they care about the earnings and the quality of those earnings. And they think that earnings in wealth management will be higher and less variable than in investment banking. By the way, for an investment bank, gains made in investment banking are income just like gains made in private banking. They're not different. So there's no distinction between.
for them.
No, for them it's just all income. For you as an individual, you'd rather, if you were buying a stock, right, you would rather get a capital gain from it than a dividend. Both of them are nice, but you're taxed more on the dividend than on the capital gain.
I guess going back to the example where we have to talk to a person who's been expert in, say, mining.
Yeah.
What would you do to keep the conversation going if he comes back saying, hey, I know my stuff?
Yeah, it's difficult. It's very difficult. You just say, you try and meet somewhere in the middle, right? Which is, okay, don't do full diversification, but do some, because some is better than zero. And you try and get them on that. And you know, it may turn out that you've given them very bad advice, but you only know that 5 years after the fact. You know what I mean? Because the mine has done incredibly and your portfolio has done nothing. But at least you can just be confident of one thing, that it's more efficient. Because efficiency in risk management is a very slippery concept, right? Because it's about the amount of return you get for a particular level of risk.
Yes.
But beforehand, you don't know either the risk or the return. So, yeah, it's difficult. It's particularly difficult because sometimes you think you might be giving them the wrong advice. But that's why it's important not to let your personal biases get in the way, right? Because even if you love the company or the strategy, it's not good advice to say stay fully concentrated. Some diversification is always better than none. That's a good question. I'll bring it up in the second half.
Yeah, because I found it tricky too. I'm from Taiwan and
Right.
my mom owns a business.
Oh, funny.
Yeah, she's been running the business for 25 years. And she doesn't believe half of the stuff that I'm sharing with her.
Yeah.
And it starts to make me question the stuff that I'm learning now, all the theories.
Yeah, you know, I mean, look, I have many business people in my family who come across the same thing. And yeah, in the long run, they're usually happy. When something bad happens, then they're happy. Yeah, as long as they feel that they can control and calibrate the risk, it's fine. But if there is an exogenous shock, that's when the power of having diversification really becomes obvious.
Right.
Good.
Thank you. That was a good example.
Good. Okay, I guess we should get going. Right, I make it 15 minutes, but clearly some of your classmates don't, so we'll give them a minute or two, shall we? Okay, let's start. Right, so diversification, right? Important point. Somebody in the break asked me how you have this conversation with somebody who's very confident about managing her own business, and you go in there, and every year you're saying diversify, diversify. And every year they're doubling revenues, and you start to feel a little bit foolish. But you have to persist, because actually, ex ante, before the fact, nobody can know what risk and return, realized risk and realized return are going to be. Your job as an advisor is to work with expected risk and expected return and help people manage their portfolios in a risk-efficient way. What does that mean? It means that for every level of return that you target, you try and do it with the lowest level of risk, or conversely, if you're expecting a particular level of variability, then you try and maximize the return with respect to that. No concentrated stock position on an ex-ante basis, ex-ante before the fact, is going to do that for you. Ex-post, after the fact, it's very easy to be wise, but before, the right advice always has to be diversification. Let me give you an example, and a very sad example, of where diversification was absolutely the right thing to do, and this person didn't do it, and in the end, she declared bankruptcy. So this was an entrepreneur that I was advising back in 99, 2000, the last big tech boom. And she'd received a bunch of stock and faced a massive potential income tax bill, right? So she's sitting on this stock, right, which is the asset, and set against that is a liability for capital gains, which is due in the following year, right? No cash on hand, single asset in this particular stock. Okay? This is, I think, late 99, early 2000. So she's got this future known liability to the UK government, HMRC, and she's got this asset, which is an uncertain stock, right? And she says, look, I know this business, I built it up, I love this business. This stock has got at least another, it had gone up like 50 times. She said it's going to go up another 10 times. What do you think happened? Not only did it lose value, the thing went to zero. The business model was fundamentally flawed. They were looking at eyeballs on websites or some advertising metric strategy, which basically completely failed. So here's this poor lady with a big tax liability to the UK government and nothing to pay it with. And unfortunately, they don't forgive you. You can't write off the capital loss because there was some complicated thing about that being received income and a combination of capital gains. So there was no offset. And in the end, this poor woman had to, sell her house and stuff to pay the asset. That's an extreme example of the perils of lack of diversification. It's a very risky example because you're taking a leveraged bet on a single stock, which we all know is a bad idea. But these are the kinds of things that can happen if you don't manage your risk in an efficient way, right? Bottom line, diversification is usually a good thing. Now, I'll get you in a second. Now, I had a very interesting Swiss banker friend who ran a quite concentrated stock portfolio. And he used to say, if you take, he had a very colorful expression for it. He said, what you should try and achieve is diversification. And what was the term that he used to describe an overly diversified portfolio was he called it de-worsification, which was a nice Swiss word, right? He said you can actually make things worse by over-diversifying. And there is some point to that, right? You need to do it in an efficient way. As I said, if you're appropriately focused on efficiency, right, in a Sharpe ratio sense, in maximizing the return for every level of expected variability, or conversely, maximize the return, minimizing the risk for every level of expected return, then you're fine, right? When you start diversifying without paying attention to what the addition of that additional stock does to the portfolio, both in terms of risk return, it's not such a great idea. Okay, so just be focused on that. I know there are lots of portfolio optimizers that do this stuff, anyway, but just be aware that you need to be sensible about how you do this, right? Question at the back.
With regards to the story you just told, was the woman liable or the company liable?
She was. She received the stock and was liable for this. Yeah, she'd exited the company. She sold out her share.
Because it makes no sense that the company went to zero, then technically there's no capital gains.
No, but when she received it, she had a significant capital gains. And you pay the tax on realization, right?
So assuming that when she received it was realized.
It was realized because she received the stock at a particular value, right? So she was given the way that the structure worked was that she, on exit, she was compensated with a bunch of stock, additional stock, in the company that she'd founded, and she was leaving, right? And she held on to it. And that was the error. Right? The immediate thing she should have done, and by the way, had she sold even, I think it was 15% of the entire holding in the week or 2 weeks after this thing happened, because the thing rocketed up, and we were saying diversify, she would have been fine. She would have had enough money to pay the tax bill and also lead a reasonable life. Clearly not as much as if the company had gone up another 10 times as she thought. So the point is, these exogenous risks in a single stock position, either a single stock or a single business, are just very hard to control. You may think you control them. You may think you've got a handle on all of the risks, right? Some risks are endogenous to the company. The case of the mine owner, you can probably manage your unions or control your transport costs. But you can't control the price of the commodity, for example, or an unexpected change in the political regime in the country. You know, in some countries, the government turns up and says, guess what, you thought the mine was yours? Well, it's not, it's ours, right? And that's government expropriation. It's a risk if you have a single asset. You know, people from developing countries understand this better. They diversify by buying properties in London, etc., right? Maybe sometimes not in the most strictly legal way from a tax perspective, but it goes on, right? And they actually probably do a better job of diversifying. One would hope that they did it more in a more legal and above board way, but it goes on, so they get it very well. Concentration is a fantastic way to make a great fortune, right? There is probably no better way than taking a single concentrated position that explodes in value to make a whole lot of money, right? But this course is not called wealth creation, it's called wealth management, right? And concentration is a great way to make a lot of money, but it is not a good way to preserve it in an efficient way. It may turn out to be an efficient way to preserve it if the thing goes like Google did, from 20 cents to 1,000 plus, but it's not the most efficient way from a risk management perspective to preserve it. And you know, I find the most difficult thing, actually, the most difficult conversation is to give people a diversification mindset, to point out to them that there are idiosyncratic risks that they cannot easily diversify away, that there are exogenous shocks that they can't control, and that therefore it is critically important to try and be efficient. We talked briefly about the regulatory and tax obstacles to diversification. Sometimes people are reluctant to sell a stock because they have a big capital gains to pay on the stock sale, and they don't want to diversify because they say, look, I don't want to take the capital gains tax now. And I tell them, it's better to pay a capital gains tax because you've got a capital gain than not to pay a capital gains tax because you've got no gain, right? So it's important not to let the tax tail wag the economic dog. If you're making a decision that is absolutely right from a diversification perspective, but you're deterred by the fact that you've got a capital gains tax to pay, that is a very bad decision. And again, I used to see that all the time. It's like, let's not do this, we'll have a tax bill. And my point was, you should be happy to pay the tax because you got a gain. If you didn't have a gain, you wouldn't have the tax. So, it was really a case of getting the causality of the thing wrong. We've talked a bit about regulatory and kind of, market reasons. If you are a very big owner in a stock, and if you control that company and are also part of the management, you have disclosure requirements, as we discussed earlier. So sometimes those get in the way of selling a stock, and you have to manage them carefully. But I think the general point I want to make is that diversification is usually a good idea. For those people that understand it, you can tell them about the efficient frontier. By definition, right? And it's by construction, and we know that this is it's a very highly stylized model. By definition, everything in here, which is a single stock, is suboptimal, because you can utilize the pattern of correlations across the returns of these stocks by actually bumping up your return. Well, you can't bump up your return, that's confined by what you're getting, but in terms of the variability of it, right, you can improve that by combining these and exploiting the correlations in these stocks. You will know from your studies and other parts of this course that actually the determinant of a single stock's return is related to its beta, which is a measure of its variability relative to the overall market. And you can always do better by combining in an efficient way than by holding a single stock. This model, in a way, is so stylized and so abstract that you almost realize when you're describing it that it's not a full description of reality, right? So in this world, everybody only ever holds some combination of the market portfolio and the risk-free asset, right? That dominates any single security choice here. The individual securities end up getting held, but in the context of this overall market portfolio. We all know that the world isn't like that. People hold single stocks, people have highly concentrated positions. So this theory is not a very good descriptive device of what's actually going on in the world, but it's a very highly stylized theoretical construct that gives you a sense of the relationship between risk and return when everything is working according to the constructs of the model, and it contains some important lessons about the importance of diversification. I'll leave it there. You've learned this in your other courses. Okay, family businesses, very important. This is a big source of wealth, interestingly, but it is not a source of wealth that is very persistent, right? So I think they did some research in Germany, it was. And in Germany, you have this incredible phenomenon of family-owned businesses that are incredibly successful, right? Many German household names actually started out as small family-owned businesses before they became very big. So Siemens and Bosch are all named after people, right? Family. Anybody know the name of the generic name of those enterprises in Germany that are based on families? What are they called? Good for your general knowledge, not necessarily for your finance degree. But the term that people use to describe that group of companies is called the Mittelstand, these small family-owned companies in Germany. Do we have some German speakers at the back who are about to answer? Right. Did I pronounce it correctly? Good. Okay. So look, they're great success stories, but you know what happens is that it turns out that, as I said, somebody did a study, and this is an astonishing statistic, right? That only 10 to 15% of these survive to the third generation. So if you're a family-owned business in Germany and you're looking for your grandchildren to take it over, you know, the record is not great. And it turns out, and you'll learn this in corporate finance and probably MBA courses, that succession planning is a big deal in business, right? And if you don't plan your succession correctly, if you do nothing else, then the chances, even with good generational planning, are that only 10 to 15% will survive to the third generation. And obviously, faced with that statistic, when you go to a first or second generation owner of a big successful family business, you're supposed to tell them, look, you really should take some money out and create an alternative source of wealth for your family, because putting it in this business is very risky. History is against you. You may be on top of the world right now and think you're running a great business, but actually you're supposed to diversify. Again, this is a tricky conversation to have because it's a successful business, it's cash flow generative, they're doing a good job, but exogenous shocks, the difficulty in managing something across generations, you are supposed to diversify, right? You're supposed to take risk more efficiently. It might be prudent to put some money aside and engage a wealth advisor to educate you in what to do, but try telling that to the head of the family. Very hard conversation to have. Many of them don't have a diversification mindset. Concentration is how they built their wealth. They believe that concentration is how they should manage their wealth. I'm here to tell you something different. Concentration is a great way to make money. It's not necessarily the best way to preserve your wealth, right? Diversification, do something about it. And advice to families is now a growing part of the wealth management business. So what you're getting, actually, and this is an interesting phenomenon, and those of you that are interested in this industry and the opportunities in it should look at this segment. So there is this new breed of providers called multi-family offices or boutiques. So what happens is a family will listen to the advice, right, that a banker like me or somebody else gives them. And they will significantly reduce or even sell their share in the family business and make, a significant sum of money. Rather than go to a big bank like a Goldman Sachs or a Morgan Stanley or a big private bank like a Coutts or a Pictet, Lombard Odier, they prefer, actually, to do it themselves. So they set up something known as a family office, which is actually a unit that follows the advice that we've been learning about in this course, right? They will come up with a plan for the family. They'll say, what are your needs? What's your risk tolerance? How much money do you think you can afford to lose? What's your return target? And they will do it for you. There will be 2 or 3 individuals, typically ex-private bankers, maybe a lawyer or an accountant in there, who will execute on the family's plan, right? And there are literally hundreds of these things that have spread up across the world. Now, a few entrepreneurs who'd made a lot of money in business sold the business, set up a family office, and then they thought, as many businessmen do, well, this is managing my money. Why can't we make some money from this? Why don't we call it a multi-family office? Let's go and find other families who've sold their businesses and combine them. And let's provide these services across a range of different families. We'll provide the same things. We'll provide asset allocation advice, strategic asset allocation, tactical asset allocation, structuring if necessary. We can build up trusts and intergenerational planning. But why don't we make a business out of this? And there are a few that have sprung up in London. I may be able to get one of them to come and speak to you. So the names, for those of you that are interested, and this is without endorsing any of them, I'm just telling you some that I've heard of. There's one called Plurimi. There's one called Crossbridge. There is a new entrant called VAR Capital. There's one called Artorius, run by a group of people from Credit Suisse. There is one called ACPI, which is named after the founders, which is quite a successful one. So there are a lot of these boutiques that are spreading up that have their origins in the wealth of a single family, but then others have pooled together and said, let's combine it in a family business. I'm told by some